Hello everyone and welcome back to another True Potential Do More With Your Money podcast. This week we are going to be discussing a topic that I know is on your lips, and if it hasn't, it definitely should be. Is cash king? Was it ever king? Well, we'll talk about that over the next half an hour or so and get the answer. We're going to get the answer from three wise men that we've assembled in the stable today as well. To my left-hand side, we've got George Bell, portfolio manager here at True Potential, and around this side of the desk, Chris Leyland, Director of Investment Strategy.
Thank you.
And Craig's in the studio as well, and you are our Technical Planning Specialist. Head of Technical Planning?
We'll take it. I've been called worse.
Absolutely. But technically, what does that mean, Craig? Tell us. What is it you do?
So really, it's helping our advisors really give advice to their clients, maybe outside of the run-of-the-mill investments. So that's maybe not just your standard ISAs, your GIAs. It's maybe more bespoke recommendations. Tax and trust planning, which maybe an advisor doesn't do every day. My team is really there to help and support them deliver that to clients. So that's really my remit, if that's the way of putting it.
So Chris and George, obviously from the investment side of True Potential. So you're going to be brilliant for this. Is cash king and all the rest of it, and how does it interplay with investments? Going to need your expertise, and obviously Craig from an advice point of view. You're obviously popular guys because we seem to have acquired an audience today, a physical audience. For those who are listening to this, that'll have made no sense, but we've got a group of people, quite a lot of people sitting behind the studio today to watch the podcast. So we're obviously popular. Well, you are anyway, Chris.
It must be me, yeah.
Must be.
It must be.
Right. The reason I want to talk about cash today, there's been news over the last week or so, people might have picked it up, clients might have been seeing it in the news, about just some of the edge beginning to come off interest rates you can get, or at least discussion heightening around interest rates, and are they going to be, will they be higher for longer in terms of savings? So it felt like an appropriate time to get into the debate around cash, and is it still king? Is it losing its crown? Just want to get your perspective first before we get into some of the specifics around this. But George, I mean, how do you regard cash as somebody who manages investments? You're looking at the composition of the True Potential portfolios, which is where a client's money ends up. To what role has cash got in those?
We're long-term investors, so being as invested as you possibly can within your risk profile is very important. November was a fantastic demonstration of that in terms of the returns that were picked up from equities and from bonds as well. Cash does have a role within our portfolios. We manage the cash allocation on behalf of clients with our discretionary permissions. The role is primarily volatility moderation. So the ups and downs which you would experience from equities or bonds in a market, cash can help you just moderate that. In times where we possibly see more risk within the markets, we've been through environments of that over the last 2 years, we would have a higher level of cash to protect against any drawdown. And then when we see the opportunity arise, we put it back to work. We've done that exactly through the course of this year. If we look at our cash and alternative allocation, we've been bringing that down and putting that into the equity and the bond market as well, which has been rewarded from a returns point of view. So with a long-term investment cap on, I think it's important to be in the market, but cash does have a time and place, primarily around volatility mitigation. And
just looking back, Chris, over the last, say, year, has as an instrument that you would use in the portfolios, as we say, as George says, if people look at their app, they can see exactly how their investment is broken down among different types of investments. Cash is amongst that, as George says. Has the role of cash, from your perspective, has it had a bigger role this year than in previous years?
Yeah, if I think around our cash balances right now, let's say take the balanced portfolio, which is our most popular portfolio, cash has actually come down over the year. So Look at where we are right now. We've got around about 3.8% in cash as at the end of November. And for us, the rationale behind why that's come down has really been focused on the opportunity set. So what we're seeing now as an investment team, the managers that we work with, are better opportunities in other asset classes outside cash. So examples of that are things such as sovereign bonds, certain types of equity where we see quite a bit of opportunity right now. And I really, as George said, we've backed that. So actually over the year, if you look at how the balanced allocation has changed, equities have gone up by around about 3%, maybe a little bit more than that. We've seen sovereign bonds an increase there, probably around about 2% overall. And some of that has been, or a lot of that has been fed by cash. So I think for us, cash is really important. It's a trading tool that we have. But from my own perspective, if I think of the balanced portfolio and I think around sort of over the history of, certainly when I've been running money, which the last 25 years, you're looking at, it's usually around about, say, 5% of a portfolio. If there's times where you want to run a higher level of cash, that could creep up to, say, 9%, something like that. But cash isn't a significant part of
and
what
I guess
we do.
if you, depending on your risk appetite, if you're as you've mentioned balance there, but if you're an investor who's in a more cautious end of the scale, or someone who's an aggressive, the amount of cash going on there would obviously change, I imagine, as well.
Yeah, it's a really good point, actually. And maybe there's kind of 2 points to make. So I think the first point to make is exactly what you're saying, which is what you tend to find is as you move up the risk scale, what you find is that you hold less and less cash. And in some ways, that's a fairly obvious reason behind that. And the other thing I would say is actually just thinking about cash itself is, I don't want people listening to this to think that we're just holding cash and it's just static and it's doing nothing at all. It really is put to work. So the way that we think around it is cash can be put into very short dated bonds. It can be put into money market funds. It can be put with a custodian whereby you get an interest rate on that cash overall. So for us, we have benefited from higher interest rates in respect of the cash holdings that we have. So for me, cash is important, but it's definitely not the most important tool that we have within multi-asset by a long way.
Have you noticed, Craig, over the last year, there's been, in simple terms, there's been a lot more talk about higher interest rates you can get on cash than in previous years. But as Chris says, it's a very small part of an overall investment strategy. Have you noticed sort of more questions coming your way from either from clients or advisors around the role of cash?
Yeah, I think naturally when you see the banks are putting rates out at 5% being a landmark figure that was announced quite heavily, clients are going to compare that against their own portfolios, and naturally so. And when you think of volatility that we've seen, you may be comparing one with the other. 5% looks very, very attractive on paper, but there's a lot that goes into that 5%. And actually, if we look at the net benefit to clients, we spoke a few weeks ago around the taxation of cash and interest. That's quite heavy. So you could lose in line with your tax rate. So if you're a high rate taxpayer, 40% of that 5% is going to be lost. So actually, the net benefit to you as an investor is going to be quite low. And one thing I would add is when we're speaking about cash, certainly from a portfolio perspective, we're talking about it as an instrument, but I think when clients and listeners and viewers think of cash, they're thinking about cash that's sat in a bank account. And whilst that's not king, it is a very, very important element and component of any investor or any client, certainly from an advice perspective. What we want to ensure with regards to cash is, has the client got sufficient funds in place to meet their short-term emergencies? When we invest money in the portfolios, our minimum term really is 5 years. So what we want to ensure is you can put that money away and leave that where it is. You have sufficient cash in a bank to utilise when you need it in a time of emergency. So in terms of cash being king, it's not, but it is important, particularly as a base level for clients.
And even then, you mentioned some of the rates you could get this year, but that crown is starting to slip. I go back to where we started this a few minutes ago, saying that you've been able to see articles and commentators in the press in the last week talking about. I'll pick one example, which was the NS&I, National Savings and Investments, dropping their 3-year bond rate. I think it was that slipped below, or the 3-year bond rate coming down anyway. Why is that happening, and what does that mean? Is that a sign of just the shine coming off, let's say?
Yeah, no, it's a really good question. What you see is, say, NS&I, so National Savings and Investing, what they do is they offer a product over different time periods. So the 3-year product's the one that's really been in the news recently. And within that, what's happened is their green bond, which is the kind of main product that they sell, the interest rate on that has come down from 5.25% to now it's just under 4%. So it's around about 3.9%. Now, why is that? It's all because what is happening, they're setting a level that they are willing to pay out. But obviously what they're looking at in that respect is how will interest rates change over the coming 3 years. So they're making a judgment call, looking at market pricing as to how will interest rates change over the last 3 years. Now, what you've seen in November time is actually you've seen quite a big change in market pricing of interest rates. So what you're starting to see now is instead of that narrative of like higher for longer in respect of interest rates, you're now seeing a narrative that actually inflation is coming down at a fast pace. You're now seeing a narrative that actually will start to see interest rates potentially being cut.
Yeah.
If we look, the UK, I think there's 3 interest rates, 0.25% interest rates being priced in to be cut for next year. If you look at the US, that's 5. If you look at Europe, that's 6. So again, quite significant changes in how the expectations of interest rates are coming through for next year.
But I mean, their expectations. But is the NS&I cutting that rate or reducing that rate? Is that a canary in the coal mine of it's actually now happening?
It's happened.
Is that yes? But in terms of rather than it just being an expectation that those 0.25% are going to, this is actually real now.
No, it's a good point. So it's basically, if I went to National Savings Investing, I had a pot of money, which I then gave to them, which they put into the 3-year product. I would now receive 3.9% per year on that. Obviously, I'd also have the taxation issue that Craig was talking about there, but that's now in train overall. So what you're seeing in the wider marketplace is that these products, particularly maybe the more long-term products, are actually starting to bring their rates down. And all of that is due to the fact that interest rates will start to come down as we move through next year into the year after.
Yeah. And people will feel that on the high street, won't they?
Yeah, absolutely. And I think, the key point is the high street product, the interest rates are coming down, as Chris mentioned, in line with where central banks are setting rates. What we've been doing is putting money to work when the bond markets and the equity markets were quite challenged, and therefore the interest rates coming down is actually a positive for the returns that we're seeing on those products. So you're getting the benefit. So Craig mentioned, 5% is a rate which was widely publicised from savings products in the marketplace for holding for a year or longer. We've just done 5% in global equities and global government bonds in 1 month in terms of the market. So, what investing in risk assets can be rewarded much more strongly over the long term.
Yeah. Well, you made the point, Craig, as well, that these, if you like, headline grabbing cash rates are very temporary, and we're already starting to see the early signs of a reduction in what you could get on a high street cash. Well, on high street cash, but these investments, we always talk about investing for the medium to long term, and that's what you've got to keep your eyes on. So if you've got a pot of money and you've chosen to keep it in cash, as you say, George, you've potentially just missed out on a great month of investment returns by switching out. So it's wise, isn't it, to be thinking about the long term always, not just what's here today, because it could be gone tomorrow. Yeah,
absolutely. And even some of the bonds which our managers have been buying, they've been locking in the income which has been coming through at much higher multiples through the environment which we've been in. So discretionary portfolio management is all about managing clients' money on their behalf. And the work which our active managers have been doing have been taking advantage of all of these opportunities that have been discussed widely in headlines around interest rates which are available, but actually even achieving some higher rates than what you can see on certain bond products such as corporate bonds.
I mean, maybe the way that I think about it is, let's say you've got a pot of money and you want to invest that money long term, and you're looking for lots of different ways of thinking around doing that. If you were to put money into a cash product, the one thing that is that you have a ceiling on how much that will make. So that, let's say if you go to the National Savings Investing, you buy that 3-year bond, that before tax, you're going to make 3.9% overall. Now, again, as George said, we think around what happened with TPP over the month of November. Well, actually, the balanced portfolio made more money than that, and that's after charges. The aggressive portfolio made more money than that. Again, that's after charges as well. So with cash, you're guaranteeing a ceiling on what you can make overall.
Over a year, that's over...
it'd be 3.2% a year.
Yes.
Yeah, so
versus
I think...
5% in the month of November that you were just talking about.
Yeah, exactly. And, I think what you see with being invested in multi-asset is there has to be a willingness to withstand some volatility. So obviously, things go up, things go down. But the key here is that if you look over the very long term and you look at how cash performs versus fixed income, so bonds versus equities, it's significantly underperformed. So this is, for me, is why if a client is thinking about their long-term goals, That's why you're invested within multi-asset. That's why we invest and use bonds and equities and alternative investments as the key components of how we build portfolios.
And is it a conversation that you often have with advisors and clients around the point that the true potential portfolios are diversified, they're actively managed, but the level of diversification that goes on in there is huge.
I think if you look at, again, the month of November being the prime example, and in many ways proves that what we're trying to do here. And I think we had conversations, even as far back as October, where clients were looking to disinvest because of volatility and the performance, their assumed performance of their fund wasn't what they wanted or expected. And on some occasions, those clients disinvested. Now, if they had stayed in the market over that November, any volatility which they've probably saw over the last year, if not longer, was automatically recovered in that 1 month. And they've missed out on that upside just because of their maybe having a short-term view on what is really a long-term investment.
Which is why we always say keep your eyes on the long-term goal. One of the first questions we ask when people invest is, what is your goal here? Because that goal, might be a 5-year, 10, 15-year goal. And as long as you keep your eyes on that, and just almost like, let a lot of the day-to-day volatility and the month-by-month just kind of go over your head. Yeah. I think that's the key from an investment point of view, isn't it?
I think so. And I think for clients as well, you're going to be emotional when you're seeing your money. Certainly on our app, you can go in and see it instantly. Yeah. You're going to get feedback of what the performance of your money's doing straight away. But actually, that's just reiterated our portfolios and the proposition we offer. And actually, December's been a nice month for speaking to clients because everything which we've been saying over the last 18 months, 2 years, etc., has come to fruition. And that remaining invested, let the experts look after your money, and long term you'll prevail.
Yeah, and November, just to recap the reasons why it was such a good month. We've mentioned inflation. You've got inflation, which is trending in a way in the United States, which is the major economy in question here, at such a rate where it looks as though the Federal Reserve's target could be achievable by the middle of next year. Now, that's a momentous change in the course of the last 12 months when we were talking about inflation in double-digit territory. You've got economic growth, which is actually surprisingly resilient despite the amount of interest rate hikes which we've seen come through. So the evidence which is driving the market, it's the market saying, okay, well, I think the Federal Reserve have probably done enough in terms of raising interest rates to bring inflation under control. They've now got scope wherefrom, and the debate is whether it'll be spring or summer, they can start to actually lower interest rates.
Well, I wanted to get into that because you've set me up lovely for the next question on my script. No wonder, because you've got a copy of my script in front of you. I do try to stop that, but anyway.
Is that what this is?
Yeah, that's right. Well read. So all eyes on the US. Is it true that in general rate cuts in the UK follow rate cuts in the US? I know that might not be a rule that it has to happen that way, but typically is that what happens?
Well, in this cycle, they were ahead of the UK in terms of putting rates up, and therefore they've seen inflation come down at a quicker rate. The speed in which it impacts the consumers is different. So a main example which we've referred to in the past is mortgage markets. It's one of the biggest expenses of the typical household, and mortgage rates in the US can be locked in for around 20 years, 30 years, and they have done the majority of that at very low interest rates. So putting up interest rates has a slower impact in terms of households. In the UK, where you've got mortgage deals 2 to 5 years, it has a much quicker impact. So although we were behind the curve in putting rates up, the actual way in which it fed through into the consumer was quicker.
Well, do you think we'll be behind the US in terms of bringing them back down again? You talked about rate cuts being priced in next year. Do you think we should be looking at the US for a hint about when that's going to happen, or do you think we'll do our own thing?
I wouldn't. If I look at kind of where market pricing is currently, the expectation is that the US will cut more than the UK next year. From a kind of timing perspective, I wouldn't say there's that much difference between the two in respect of when we see the first cut come through. I think there's a couple of things that people are thinking about. So firstly, the strength of what we've seen within the global economy, but then how does that look within both the UK and the US? So one of the trades that we've been looking at and our managers have been looking at is buying UK government debt, so what's known as UK gilts. And the view there is that potentially the UK economy isn't maybe as strong as what we're seeing from the data from the US. Therefore, we could see maybe further cuts come in the UK than what's priced in overall. And that will be better for UK government debt. So when you see interest rates cut, you then see yields come down, which means that prices go up. So the kind of opposite of what we saw in 2022. So from my perspective, I'd say I wouldn't necessarily say that the US is leading so much on the way down. If you actually look at the charts, other than the amount that's actually priced in to be cut, the key thing is that all developed markets, well, UK, US and Europe, are all expecting interest rate cuts next year.
Wage growth is one of the key dynamics in the UK, which is keeping inflation, we call it sticky, it just means it's more persistent than what we're seeing in the States. But the data which we see suggests that we are going to start to see wage growth moderate when we see the year-on-year comparison, because if we think about what we've seen over the last 10 months is quite a big increase in terms of public sector pay awards or pay increases come through. That's going to drop out of the calculation, which means that the wage growth pressures are going to moderate, and therefore you should start to see some quite fast revisions in terms of in terms of UK inflation data. And it's a similar picture in Europe as well. We expect we're going to start to see European inflation come down pretty quickly. And, we've talked about the different tools which central bankers have in terms of interest rates or, the amount of bonds they buy. Another tool which they've got is just the narrative, the way in which they describe how they're going to behave. And at this point in time, the European Central Bank have been saying that we're going to keep interest rates at their current level until we've got real evidence that we're going to hit target. We think it's going to be the narrative which is going to have to change because we're seeing disinflation in Europe.
I mean, speaking as a lay person and probably our clients as well watching and listening, this blows my mind because you've got interest rates potentially coming down, because inflation is potentially going to come down. Why is inflation coming down? Partly because of, as you say, wage growth will level off.
Yeah.
Why is wage growth leveling off? Well, because if interest rates are coming down, that means mortgages could be, I'm simplifying this, but if mortgages are going to become, if not cheaper, then certainly not get more expensive because interest rates will come down.
Mortgages have become cheaper. So if you look at the rates that are on offer.
Unless you got into a fixed when it was.
You could be.
But so I'm trying to work out what is causing all this, but it seems to be just one massive big circle.
There is a number of aspects that feed into one another. I mean, one of the key aspects is just the calculation. We're doing a year-on-year comparison where we went from, pretty low levels of activity because everybody was locked in the house and services were inactive in many cases, to an environment where you had a huge amount of spending and prices went up. And then we had the doubling effect of the invasion of Ukraine and the impact on the energy market. And then what we've seen is a lot of that build up start to drop out of the calculation. So that is one aspect. But then there is other aspects, including what we're seeing in terms of wage costs. There's the impact in terms of housing costs. As mortgage costs went up, it means that the actual change in housing, people moving from one to another has slowed down. Also the labour market, there's a huge amount of individuals shifting jobs and being able to negotiate higher pay as they did that. After lockdown, that started to slow down as well. So we had this big heating of the economy out of lockdown, and that's just started to moderate, which brings us to the aspect of economic growth. We've mentioned inflation, we've mentioned interest rates. What is the reason for bringing interest rates down? It's, yes, they believe they can get to inflation, but they also need to be very careful not to fracture the economy along the way. The US has been surprisingly resilient economic growth. In the current quarter, so the final quarter of the year, when everybody was talking about recession at the start of the year, it's trending at 1.2% positive now, even after all the interest rate hikes we've seen. And in the UK, although economic growth is not as robust as what we're seeing in the States, it is surprisingly robust. So, there's
been talk this year of we're going to be in a recession by the end of it, or we're going to be, and we haven't ended the recession. So even though growth has been pretty flat in the grand scheme of things, we've managed in the UK to avoid getting into recession kind of dangers, haven't we? So what does that tell you? I mean, does that tell you that? So have we outperformed as a country, or were the forecasters being too negative? What do you think?
I think what this is what it tells me, and George might disagree on this, and what it tells me is, I think the global economy has proven much more robust compared to what individual forecasters were expecting. Yeah. I think within that, I think the UK has proven more robust. than what individual people were expecting overall. I think there was probably quite a negative viewpoint around where we would end up in the UK. I think Europe in general has proven more robust as well. So I think for me, what you've seen is a lot of individuals maybe paint more of a negative picture than actually what we've seen come through.
Come on, George, disagree with me.
No, I agree. I mean, the amount. What's been surprising is the resilience of labour markets. We haven't seen a huge tick up in unemployment, and when you've got individuals in jobs, and actually in a number of cases being able to negotiate higher wages to manage higher input costs, higher living costs, then that's quite a powerful feature to recognise in this cycle, which has been difficult. It's been the headwind for the central banks because they're trying to stop cool spending down, but you've still got such strong labour markets. We speak to businesses on the ground, and there is examples of businesses where, in a lot of sense, they're just cautious about letting workers go because it was so hard to get them back in the door. They want to keep them because they know how.
And if these are in the grand scheme of things, temporary, short-lived bumps in the road, you don't want to be in a position where you've made a long-term decision based on some short-term factors, if that is indeed what's happening. But you've done it again. You've mentioned businesses and companies. And I wanted to ask Craig about this because if interest rates come down, that's good news, and wage growth levels off or even begins to come down, but certainly levels off. That's good news for businesses, right? So, yes, agreed?
Yep.
Good.
Yeah.
Absolutely. I'll keep going then. So that's good for businesses' bottom lines, which therefore is good for their share price.
Yep.
And that feeds through to investments, doesn't it? And feeds through to portfolio the returns you might see in your portfolios if businesses are healthy and growing and feel confident to invest.
It's probably twofold. Obviously, there's the investment aspect and the positivity in businesses and in corporations and how that helps profit and drives profit, which in turn makes the equity price go up, which feeds into portfolios, which is certainly what George and Chris were talking about. But there's also the effect interest rates and inflation and cash rates have on clients and consumers as well, and that's the other side of it. So you've got mortgage being a tangible one that most people will be exposed to there, and really I think people think of inflation and it's a bad thing straight away, and there's a lot of noise, there's a lot of components as George touched on, and really our job as an advisor is to try and interpret the complexity of it and all the noise and try and cut through that and say actually at the core of that is professionals who look after your money. Let them do that. Let them make the decisions on your behalf, and actually trust them over the medium to long term to prevail. So that would be kind of my message. There's always going to be noise. There's a lot going on. There's several components, multifaceted, but actually at the core there is a client's money. And the medium long term performance is ultimately what they're there for.
Oh, 100%. I think professional advice and professional investment expertise is certainly what you need. So, if let's look into a little crystal ball. I mean, I know you bring your crystal ball along to the podcast, Chris. You love to look ahead. If you look ahead to next year, we are going to hopefully see some of these interest rate decreases that you've talked about, which on the face of it, from a cash point of view, might look like bad news for cash savers. But that's our point, isn't it? If you're an investor, if you're investing, that should feed through to company growth, and therefore growth in your investments that are invested in companies at the end, and other assets as well, of course. But this could be. I was going to touch the table, but I know we're not allowed to bang the table. But you kind of could be good news for investors.
Yeah. The one thing I've always learned from investment is don't look into a crystal ball. But what I will say is,
look into a crystal glass then.
Look into a crystal glass. This is not a crystal glass, but what I would say is, if we look at where we are now, the headwinds that we saw last year, so rising interest rates, very elevated inflation, those headwinds clearly are starting to clear. And you can see from November's performance what happens when that changes overall. So I think, for us as a team, an investment team, George and myself, we're seeing a lot of opportunity in assets right now. We talked around the fact that cash has come right the way down, and that's because we're seeing good opportunities to spend that money to make money for clients overall. So for me, the macro environment is seeing less headwinds compared to certainly where we were last year. A lot of those headwinds are now starting to not fully disappear, but starting to peter out. And then as well as that, you've also got a lot of opportunities coming through. So For us, it's a good time to be working on the true potential portfolio proposition.
And a good time to be invested in one as well.
Definitely, yeah.
Right, let me come full circle then as we begin to wrap up or peter out. As
when I said peter out, I wasn't sure how you'd react to that one, but I thought
I reacted the right way.
Yeah.
I took it as your hint to say Peter.
Peter out.
Stop shutting up. And bring this one to an end. Because I've used up all my knowledge about everything I can talk about. So back to where we started. Was cash ever king? George, come on.
No. We're long-term investors here. That is our objective. That's what we're here to do. And in that risk assets, history will tell us, have been rewarded and outperformed cash. We'll use cash as and when's appropriate to manage the volatility for clients. So it is a feature of our portfolios. It's not sat in and nothing. It is getting a yield or a return on that long-term. Risk assets. And that's why we have different risk profiles to recognize, the tolerance which clients have, whether you are aggressive and you want to have more in equities, or whether you are more defensive and you've got, you need the money, in a little bit earlier. That's when you would potentially use more cash in your portfolio. We'll do that on your behalf.
Okay. And what would your final message be, Craig, then?
Yeah, cash is important, but not king. It's useful for every client to have. They need it for affordability, but you shouldn't put all your eggs in the cash basket, as it were. So, that would be my parting message.
I don't think I can beat that. Don't put all your eggs in the cash basket, but I'd say
for me,
just bang the table. For me,
you knocked your crystal glass.
I know you knocked the crystal glass.
Yeah.
Look, for me, cash is never king over the long term.
Yeah. Well said. Brilliant. Excellent. Well, look, thank you very, very much. That's certainly been a useful discussion, I think, and certainly, as I say, we're beginning. And clients will have done this. Clients may have picked up some in the, some discussion in the news around this very topic, which is why we thought it would be useful to spend half an hour today going through it and giving you the opinions and the experience from the experts we have here at True Potential, so you can begin to get an understanding of why you might be reading those headlines, why you might be reading those articles, and if not looking into their crystal ball, then a little bit of a look ahead to what might be coming up over the next year or so. But as ever, of course, things can change and we'll keep you posted. That's what these podcasts are all for, as well as all the other content that we produce. You can keep in touch with our social media channels and blogs, and you'll find a lot more content from these guys there as well. But thank you very much, George. Thanks, Craig, and Chris as well. And thank you very much for tuning in this week to the podcast. We'll be back again, so hit subscribe and give us a like, and we'll see you next time.